And good morning and welcome to the Q1 results call for Schaeffler India Limited. Today we have with us Mr. Dharmesh Arora, CEO Schaeffler India, and Mr. Satish Patel, CFO Schaeffler India. I now hand over the call to Mr. Dharmesh Arora to take us through a short presentation on our results, and over to you, Mr. Arora.
Thank you, Vijay. Good morning, ladies and gentlemen, and once again, a very warm welcome to all of you to our Q1 investor call. We announced our Q1 results yesterday, which was followed by the annual general meeting, which was well attended here in Mumbai. We also uploaded the Q1 investor presentation, which hopefully all of you have been able to see, and also have it available with you as reference, because that's the one that I will be using to walk you through our performance of Q1 2018. So with that, I will try and reference the slide numbers I am on. Slide number 2, just the overall sketch of the contents of my presentation. As usual, I will talk a little bit on the economic environment and how we see that developing, followed by financial update for Q1 2018. The merger transaction is proceeding well as it was planned. I'll give you a little bit update on the timeline for that and an outlook, and then wrap it up with some of the key takeaways from my presentation. Moving to slide number 3. Yes, the headline is that India is now once again the fastest growing large economies in the world. We have all seen the GDP growth numbers coming out in the last 2 quarters of 2017, which are once again pointing to an upward trend. 7.2% GDP growth for the last quarter of calendar year 2017. Subsequent to that, and around this time, and of more relevance for industries like us, is the IIP numbers, or the Index of Industrial Production. The industrial output is very encouraging for the last some months. The growth has been hovering somewhere between 7 and 8% in these times. Since the industrial output makes up close to 25-30% of the GDP, we are also hopeful that based on the January-February numbers that we see here, the GDP growth for the Q1 2018 should also see some healthy improvement. Of course, the consumer price index has risen in the last months, primarily driven by the global commodity prices, crude oil, and some local food prices related inflation. There continues to be a massive investment push by the government, as it was announced in the budget, which is again a very good sign and good opportunity for businesses like ours. On the negative side, from the same union budget, of course, has been the hike in customs duty, which will have an impact on our business, since we do import raw materials, we import some components as well as finished products to have a complete basket of products available to our customers. Moving to slide number 4, subset of the Index of Industrial Production, some of the core sectors that we track. Cement has particularly seen very strong growth in the Q1 2018, but let's admit that this is coming from a relatively low base we had seen in the first quarter of 2017 at the back of demonetization, where the real estate business, the construction business had taken a beating. But nevertheless, I think it's nice to see some really smart recovery on the cement production. Similarly, the other core sectors, the steel, coal, and electricity generation, have also seen growth anywhere between 2 and 6% here. Moving to the slide number 5, which is the automotive or the mobility section. And this is where it is really heartening to see really nice, smart growth. The two-wheelers and three-wheelers, once again, in Q1 have grown close to 30%. Once again, it started with a low base of Q1 2017, which was affected by demonetization. But, even if you were to discount for that factor, the two-wheelers industry probably has seen about 11% growth in Q1, and anticipated growth for the rest of the year also looks strong, given the push in the rural economy, general rural economy doing well, and so on. Commercial vehicles and tractors, agricultural tractors have been absolutely, nice. The growth of 27.6% and 28.1% respectively on CVs and agricultural tractors. This really are setting new numbers each month, and very, very strong growth here. Based on our conversations with customers and based on the outlook that was provided by the weather department yesterday, that the monsoon is expected hopefully to be normal, we again expect that these sector, particularly the tractors, two-wheelers, will continue to see good growth. Passenger vehicles have also seen reasonably good growth, 6% for the Q1 2018. Most of that growth is driven by the sports utility vehicles, SUVs, and again, many of our customers, of course, led by Maruti, Tata, and others have really seen very smart and good growth there. From the macroeconomic environment, let's now move to our own performance, the company's performance. So let me jump to the slide number 7 here. The Q1 results of 546 crores, net income, which is a growth of 14.5% compared to the same quarter of 2017. Compared to the immediately preceding quarter, which is Q4 of 2017, the growth is 4.1%. Most of this growth, particularly from the last quarter, is coming from both our automotive and industrial. The export business has not done as well related to the Q4 2018, but the domestic market has really been very, very strong. And this is kind of reflected in the sales mix pie, which is shown on the chart at the bottom right of this page. This is the chart showing the overall sales mix of our business in Q1 2018. So 58% of our sales in Q1 came from what we produced in our own plants, Maneja and Savli, and sold to our domestic customers in India. 15% of our overall sales was related to what we produce and export to our own group companies outside of India, and 27% of our sales is of the products that we import for selling to our domestic customers in India. As you can see, the sales mix did change a bit in this quarter. So the sales mix for the domestic sales went up by 3 percentage points. So what it means is that in Q1 2017, 55% of our overall sales came from own manufacturing and destined for local domestic customers, whereas in Q1 2018, it jumped to 58%. On the other hand, the sales contribution of exports reduced from close to 18% that we had in 2017 Q1, now reducing to 15% of overall sales mix coming from exports. Now let me go up to the next slide, slide number 8 here. On the profitability side, the EBT here, the EBT levels of 981 million Indian rupees, which is higher than what we achieved in Q1, and overall profit levels of 18% for this quarter. But compared to the immediate preceding quarter of Q4 2017, this is a reduction of 1.4 percentage points, but very much in line with the Q1 of 2017, as well as the whole year performance of 2017. So basic message is that, yes, we have been able to sustain the EBT levels that we had achieved in 2017, which was a significant improvement over the 2016 levels. The slide number 9 gives a little bit more details on those numbers, but I think most of them I did speak to in the graphic way in the preceding slide, so I'm going to skip this. Slide number 10 is giving the picture of the other two legal entities, the INA Bearings India Private Limited, Look India Private Limited, as well as what the performance levels are of the pro forma basis of Schaeffler India Limited. So INA Bearings India Private Limited achieved a sales of 316 crore, which is a growth of 10.6% compared to the same quarter of 2017. Profitability level of EBT margin of 9.8 percentage points, which is slightly better than what we achieved or what the company achieved in calendar year 2017. Look India Private Limited achieved a sales of 256 crores, which is a growth of 30.2 percentage points compared with the quarter one of 2017, and EBT margin of 14.3%. Once again, that's better than the calendar year 2017 levels for that company. A lot of this growth is, consistent with the growth, of course, in the automotive sector. But importantly, the very nice growth in Look is at the back of very strong demand for commercial vehicles and agricultural tractor products, which make up, fairly large portion of the Look India sales. On the pro forma basis, the sales were 1,113 crore, a growth of 16.5%, and also the EBT margin of 14.9%, both of them better than what we have been able to see in the past years. Now let me give an update onto the transaction, the merger transaction itself. So I'm on the slide 12 now. It listed down all the regulatory steps we have to go through in order to complete the merger. I'm glad to announce that all these tasks are going as they were originally planned. Last month we had the extraordinary general meeting of the shareholders, where the shareholders have overwhelmingly voted in favor of the merger to go forward. And we have now, the merger proposal is with NCLT for their final approvals, followed by we informing the stock exchanges and SEBI with the merger process getting completed as it was planned in quarter 3 of this year. So with that, let me wrap up by saying that yes, the economic growth momentum is picking up, and we are very glad to see that, and we are expecting that this should continue through most of the year. There is a very strong domestic demand, and with that, the opportunities for us, both in automotive as well as industrial business divisions of Schaeffler India. The better sales volume support us to maintain the EBT levels that we had achieved in 2017, and we expect that the growth not just continues, but with the GST impact more or less behind us, we in fact see this picking up even further in the months to come. And finally, the merger process that we had announced on August 30th, 2017 is on plan as it was announced, and we hope to complete the merger by quarter 3 of 2018. So with that, we are all marching towards one strong Schaeffler entity in India, and that with that I conclude my presentation, and I hand it back to Vijay, who will advise the logistics for Q&A. Thank you.
Stanford, you may proceed with the Q&A process.
Sure, sir. Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1 on your telephone keypad. The first question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, very good afternoon. Good morning, sir.
Morning.
So my first question is pertaining to the sales mix that we have provided on slide number 7. Of course, one way to slice it is in the form of graphical representation that we have done between manufacturing, domestic manufacturing, exports, and traded products. If you could also help us with the breakup between the other way, that is automotive, industrial, and exports or aftermarket, the way we do it.
Sure. Well, I think we had shared, in the quarter one, or rather the calendar year 17 result, that overall, when you look at the pro forma basis, almost 57% of our business in India is automotive, and 43% coming from industrial. So that makes, quarter over quarter doesn't change much, and what we'll do, Swapnil, is to keep giving this information at least on a 12-month basis as to how we see this evolving. But the good thing really is that the growth in quarter one for both automotive and industrial was both of them was fairly strong, and that's really very, very encouraging that we are able to maintain sort of the healthy mix we have between both automotive and industry when it comes to pro forma level. Coming to the Schaeffler India Limited, the legal entity alone, then automotive contributed 19% of overall sales of Schaeffler India Limited legal entity, and 81% came from industrial.
And is exports a part of industrials or?
Primarily, I think I've been sharing that that the business model of industrial business is such that there's always imports and exports of a very wide portfolio we do have. So the exports are primarily in industrial business.
Got it. So secondly, we've seen a decline in exports, as in the share of exports has come down by 2.3 percentage points, as you've highlighted. Could you help us understand, is this primarily a function of a movement in the currency, or is it more pertaining to slowdown in specific geographies or specific sub-segments where we supply these products?
Sure. Yes, we got a nice sort of, long-term, business relationships and contracts, of course, with our customers in India on the automotive as well as industrial side. And exports, our business primarily is to, export the products to our group companies in other countries who ultimately make those products available to the end customers in the regions that they operate in. So I think the quarter one change in our sales mix, one is at the back of, very strong demand domestically. So I think, the growth, particularly, both in distribution as well as in OEMRO, at the back of probably the GST, behind us, and general economic activity really picking up has been particularly strong. So I think, we have been able to serve our customers domestically in a nice manner, and that has, resulted in, some sales mix change here for the quarter one. But once again, quarter one or one quarter is too early to, make any definitive comment whether this will be, the way it is seen. Last year, I think if you recollect, we had a very nice growth in exports, and we look forward that, we are able to maintain a very nice mix between both and exports and domestic markets in times to come.
So if I understand correctly, basically we've allocated more production capacity to domestic customers, and it's got nothing to do with a weak demand in exports or anything like that.
I won't say so. I mean, we all know the GDP growth globally has been, particularly strong. I think now 3.5%, 3.7% level. So good news is that the demand remains, strong pretty much from all markets of the world. And, we would continue to see as to how we can participate appropriately in all the growth opportunities.
All right. Secondly, on the margin side, we've seen a significant reduction in our gross margins. Would want to understand that is it pertaining to only the mix that we've been doing less exports and higher domestic sales, or has it got to do more with commodity prices since steel prices have been firming up? And you mentioned yesterday that you've taken a 4% kind of price increase across products. How much of the commodity price increase has been mitigated through this 4% hike?
Sure. Actually, you have to really, go back to the Q4 2017, and if you recollect, we had a particularly strong performance on the profitability side on the Q4 2017, and this, of course, was an outcome of, a couple of things. One, very healthy sales mix that we had seen in that Q4, with the distribution business really picking up, after the demonetization, or rather GST impact really settling down, exports picking up, or exports being particularly strong. So the sales mix was really, very, very favorable. And also we had some special impacts related to the full year in that quarter particularly, which was the, favorable actuarial valuation of employee costs. So this is something, was comprehended in the Q4 performance. Moving to the Q1, the sales mix is not as favorable as it was in Q4 of 2017. And also, some of the special impacts that we had in Q4 are kind of not there in Q1. But more importantly, I think, what I would like to highlight is the level of profitability that we have delivered in Q1 is also comparable to what we were able to achieve in for the whole year of 2017, and that's something for us extremely important that we have been able to give similar results as we were able to achieve in 2017.
Right. And pertaining to the steel price hikes, how much have we been able to mitigate through this price hike?
So there's always a little timing difference here, right? I mean, you would appreciate that, once the commodity prices are rising, you are unable to, realize, all of that, and for that matter, at the same time from the market. So as you referenced that, yesterday at the AGM, I shared the thought that, we are increasing price of our catalog products across the board. And this is effective actually April 1, 2018. So those price increases have actually not even shown up yet on our Q1 results. So, this is always the case that, the price increases or the commodity increases, there's always a lag of our ability to realize that from our customers. And I think this will be something that will happen over the course of the year.
And so one final...
Excuse me, this is the operator. Mr. Tulsian, may we request you to come back in the queue, please, for a follow-up question?
Okay. Sure, I'll do that. Thank you.
Thank you. The next question is on the line of Nishit Jalan from Kotak Investments. Please go ahead.
Hi, sir. Sir, last quarter you mentioned that we have a big capex plans to expand capacity in both INA and on the Schaeffler India side. So just wanted to check where are we on that right now, and just a follow-up on that is in INA. Is there a capacity constraint because of which we are seeing lower growth, or is it the kind of growth that we were expecting we are able to deliver on that?
Thanks, Mr. Jalan. Yes, I think, we are on course with the announcement that we had made of doubling our capex allocation for this year and the next year. So as we speak, we have plans of investing close to 40 million euros in India in terms of expanding capacities, bringing new products, and also enhancing our R&D capabilities in the country. We started the construction of the second plant, the hall, at Pune late last year, and that's well on course. The building is expected to be completed at the end of this year. And similarly, we would also start enhancing our plant building space in Savli towards the later half of this year. So these were all part of the plan of the 40 million capex plans that we have made for the year, and that's well on its course. Coming to the INA performance, I'm assuming you're referencing the growth of 10.8% year over year in the Q1 2018 for INA, compared to probably, higher level of growth, we have delivered in that company in the past. Let me just give a couple of comments on that. One, INA's business is largely, automotive business. 75% of the business comes from automotive, and within that, that automotive business is primarily passenger vehicle driven business. And passenger vehicle industry in the Q1 2018 has grown 6% year over year, whereas, as you can see, INA's business grew 10.6%, compared to the year before. So clearly, one, we have been able to outgrow the automotive passenger vehicle industry, which is what the INA's business to a great extent is linked to. At the same time, some of the program launches that, a couple of our customers in automotive space they had to delay or retime them. So it's also some kind of a timing effect of the volumes and the ramp-up which were planned have not yet happened. And we certainly look forward to, getting back to even higher level of growth in future. But to some extent, it's also linked with how the passenger vehicle industry performs for the rest of the year.
Thank you, sir. Sir, my second question, if I look at the company's annual results, for example, if I look at the annual report last year, the gross margin on traded goods, something which we calculate from the annual report, that tends to be really volatile if I look at an annual basis. The broad range is somewhere between 17-18% to up to 27%. So just wanted to understand what drives this volatility and how should we look at it in terms of on a steady state basis.
Yeah, let me ask Satish, maybe, hopefully he can give you a better insight into it.
Right. So, Satish Patel here. Your question is oriented towards why do we have so much of volatility quarter on quarter or year on year if you look at a couple of years back in the trading margin situation when you refer the sales to disclosed figures of the cost or the cost of sales in the annual report.
Correct.
We have a couple of reasons for that. One is the FX situation in the respective years. Some years have FX gains, some years have FX losses. And as you know, the accounting wise, the gain and losses from the invoice to the payment gets accounted in the special another disclosure of FX gains and losses, and not along with the cost of sales of the traded products. So when you combine the FX losses and gains, which are separately disclosed, the volatility that you find should not be as high as what you perceive or what you see there in the report. This is reason. The second reason is I can more or less confirm that in terms of overall sort of margin or the pricing situation for the traded products, there is more or less a consistency. Because the prices are determined purely based on the arm's length, and unless there is a significant change in the COGS coming from the global impacts like the steel price increase or like some input cost increase, it is unlikely that the margin situation vary significantly between the periods.
Okay. Thank you, sir. So just one final question on the aftermarket segment. Last quarter, you highlighted that we have seen a very strong recovery. Just wanted to check whether the momentum continues or we are seeing some slowdown over there.
I think the momentum is continuing. We still have, nice demand and order book from the distribution business.
Any numbers you can share in terms of growth that we have seen in this quarter or something?
I think, our distribution business roughly contributes about 36-37% of Schaeffler India Limited's, overall sales revenue. And this certainly has seen double-digit growth in the last months, and that's something we are still experiencing for the foreseeable future.
Okay, thanks a lot, sir. That's all from my side.
Thank you. We take the next question from the line of Keyur Shah from Emkay Global. Please go ahead.
Hi. It's Keyur Shah.
Excuse me, this is the operator. Mr. Shah, there's a lot of static noise coming from your line. May we request you to use the handset, please?
Hello?
Mr. Shah, there's still a lot of static coming from your line.
Okay, I'll get back to you.
Sure, thank you. The next question is from the line of Sagar Shah from KSS Shares and Securities. Please go ahead.
Hello, good morning, sir.
Good morning.
Yeah, I just have few questions actually. The first question was related to the sales mix. I just wanted to confirm that our auto business contributes about 57% to only the FAG brand, I am saying, something like only the Schaeffler India group, Schaeffler India Limited.
Well, I know there's a lot of numbers here, but let me correct it one more time.
Yeah.
So Schaeffler India Limited, the legal entity FAG, erstwhile FAG Bearings India Limited.
Yeah.
For that legal entity, automotive is 19% of overall sales.
Okay.
And remaining, of course, is industrial, which is 81%.
81%.
Now, on the pro forma basis, when you put ENA's business with it, when you put Luke's business with it, then we have 57% is automotive and 43% is industrial.
Okay, yeah. Sure, sir. Got it. Yeah. Now, my second question was related to the capacity utilization. That can you tell the capacity utilization for both our plants, for the Schaeffler India Group?
Sure. Savli, which was the plant set up in 2012, we have two different segments there, the DGBB Gen C bearings, and these segments, we have 6 lines there with a total installed capacity of 60 million. And this is pretty much, 100% utilized. So the demand and supply there is, fairly well matched, and, we are using all that capacity. The large size bearing, which, is primarily, going into sectors like steel, raw material, and particularly wind sectors, we are making expansion of capacity there since last year, and the utilization there is not, close to 100%. In fact, I would say it's maybe close to 60% level. And there's also a function of how the wind sector for the last couple of quarters has seen softness in demand due to the new tariff structure, which is, sort of getting established. So that's Savli. Maneja, when it comes to Maneja, once again, we've got, most of the segments there are very well loaded, and overall plant perspective, we see close to 90% plus utilization at Maneja.
90%. Okay. Now my third question was related to the trading business actually. The trading business almost contributes 27% of the total revenue as indicated in your investor presentation.
Right.
So going ahead, is it something like if we, by the end of this year, if we're going for capacity for capex at the Pune plant and we're also expanding the Saudi plant, can we expect the trading business to at least we can grow on own manufacturing domestic rather than just trading products?
Sure. I mean, our intent, of course, is to continue to expand our local manufacturing footprint and produce more of what the customers need locally here. It's always a function of, having the appropriate volumes and finding, reasonable business cases, having the appropriate quality and, capability available in the country to localize, such products. But our long-term intent always is that, we want to produce more of what is required by our customers in India. Having said that, once again, our portfolio is very huge, and, at no point of time I would say that, we will be able to produce everything that our customers need in India. So directionally, I would agree with you that yes, we would continue to work on reducing the percentage sales mix that is contributed by traded products over the years to come.
Another question related to the same question actually. Are we trading products related to our brand or something like other brands? Are we trading to other countries when you give the products in the trading business? When we are trading in something like other brands or the Luke brand, on which brand are we trading on?
So once again, the chart you are referencing on slide 7 is limited to legal entity Schaeffler India Limited. So here we are talking about primarily FAG products, but maybe to some extent maybe ENA products as well. So these are the products that we buy from our group companies in other countries around the globe, import them to sell them to our local customers in India.
Okay. Yeah, got it. Yeah, my last question was related to the imports. As you have indicated actually, and you have mentioned just a few minutes ago that we'll be something like affected by the increase in the custom duty and cess on imported auto components. So something like, I wanted to know what is the import value actually of the entire 2000, something like you can give for this quarter or maybe for the last quarter. What is the CIF value of the import actually that we are actually importing for these imported auto components?
Sure. Maybe I can give you some, high-level numbers here. As you can see that, we import 27% of, finished goods that we sell to our local customers. But, within the rest of the 73% products that we either produce to sell to our own customers here or export, they also have some import content in them. So we might be importing, let's say, some specific type of, seals that go into producing those bearings or those products, or in some cases we might be, importing some rollers or which are used for producing those bearings. So overall perspective, at Schaeffler India Limited legal entity, our overall imports will be maybe more towards 40% level, not just 27%, but we might be importing some components which also go into our local production. So for Schaeffler India Limited, more like 40%. And if you really are trying to understand as to what could be the impact from these duties and so on, it could be roughly, in our opinion, close to 1% of sales is the overall impact from these recently announced duty impacts, and that's on all Schaeffler India as a group.
So you're saying 40% off, sir? 40% of the, I didn't get actually, 40% of the value, you're saying? So for the imports, you're saying?
Right. So, for Schaeffler India Limited, roughly about, 40% of all our things will be into imports, and, both for finished good as well as, that includes maybe sometimes, the raw materials and components, individual sub-components that we might be importing.
Okay. Yeah, sure. Yeah, that's it from my side. Best of luck. Yeah.
Thank you. The next question is from the line of Krishna Kumar from Sundaram Mutual Fund. Please go ahead.
Good morning, sir. Congratulations on a good performance. You're talking about price hikes, right? So you said it's about 4% across the catalog. So I guess this refers to the distribution business. And so from an OE perspective, has it been done, or, what's the kind of timeline we see that the OEs also, give us the pricing increase?
Sure, Krishna. Yeah, so the realization of price is not just a function of we announcing a price increase, right? You would realize that we have, various kinds of contracts with, different customers. There are customers where, the price increases are either not feasible or linked with the certain commodity prices. Then you have the function of course, negotiations and concluding the negotiations satisfactorily and so on. So I don't want to get you have a sense that, from April 1, our sales, will go up by 4%. It's just, something that is the first step to go out to the market and say that, the input costs have gone up, and to compensate for that, we are increasing our catalog prices across the board. But the realization of price is a function of, the inventories our customers are carrying. When would they start ordering the new price level inventories from us? What our ability is to realize that level of price increases based on the individual relationships we have and the contractual commitments we have with each one of those customers.
Sure. The second part, sir, is, when you talk about industrials being a higher part of the business mix in the listed entity and then, a little lesser in the overall entity, I guess you club also the commercial vehicle part of the business also into industrials, right?
Well, Krishna, for bearing business, it is included in transmission bearings, it's included in industry. But, clutches, for example, we have a large business of clutches to commercial vehicles. That's primarily, or that's all in look business, which is all we consider automotive. So it's a little bit complicated.
So if you just look at the listed entity, within that 80% industrial, what would be the exposure on trucks, basically?
Very little. So, like I said, 19% of the business comes from automotive there, and 81% comes from industrial within the listed entity, Schaeffler India Limited's revenue. So over there, the automotive will be primarily wheel bearings, which go into the passenger vehicles primarily, and some other bearings which we supply to tractor customers and trucks. But mostly it will be chassis wheel bearing business. And rest, in industrial space, it will be two-wheeler bearings. To that extent, automotive is included in our industrial piece of business for listed entity.
Sure. And last question, sir. In terms of, I'm sure you map the competitive activity in terms of what others are doing. So particularly, are you kind of seeing any strong inroads by other players in our business segments? Would it be possible to comment something on the competitor activity and how you see that going forward?
Well, we of course, have, our business that we focus on and, we keep an eye on. But, again, at this point of time, I would say, with the opportunities available in the marketplace and how we continue to, grow our business and long term, the initiatives we have in place, we feel, fairly, good in terms of, our ability to continue to grow our business. And more importantly, our focus is all about really, making this merger success and ensuring that all the synergies that we are expecting to realize from this merger, we are able to execute that. And with that, we are creating a much stronger entity in India, which would be, far better placed in warding off the competition, which is in the market. This company also has a very nice mix between automotive and industry. So once again, inherently, we are also trying to make our business stronger to sustain these sort of, cyclical or other, situations in the marketplace. So clearly, I think the steps we are making, the steps we are taking is creating a much stronger entity in India.
Thank you, sir. Wish you all the best for the future.
Thank you.
Thank you. The next question is from the line of Achila Kanetkar from Birla Sun Life Mutual Fund. Please go ahead.
Good morning, sir.
Morning, Achila.
Sir, I just wanted to get a little bit understanding on the balance sheet part of INA and Luke. So if you could share, what's the debt in these two companies as on CY17, because P&L has been shared. Just wanted to get a sense on the pro forma balance sheet as well. If you could share the net assets and at least the debt and the net assets part of the two companies.
Yeah, so as far as balance sheet of INA and Luke is concerned, you are right that not so much of data or the disclosures are available. But I do like to mention that as part of the merger scheme announcement, we have announced balance sheet figures as well. Not the full-fledged balance sheet, but the key figures of net asset, net worth, and similar key figures. So such figures are available on our website under the merger scheme portion of the disclosure. I do not have all the figures, but I can comment about two figures that you like to know. One is the one is the borrowings. As far as INA and Look India are concerned, both have two types of borrowings. One is the borrowings in Indian rupee currency, which is purely intercompany borrowing. So INA has borrowed about 900 million rupees, which is 90 crores from Schaeffler India Limited. And Look has no Indian rupee borrowings. Both the companies do have borrowings of in the form of external commercial borrowings. I do not have the ready figure, but I do confirm that they are in the range of approximately in the range of about 100 crores. So this together. Yeah. This Look has very low borrowing in foreign currency in ECB. Largely borrowings are from INA India. The second question was related to net asset or the gross block. There again, I do not have the figure, but I can confirm more or less that that the overall gross block of INA and Look India is similar to Schaeffler India Limited. Reason being, INA is a young company. Assets are quite for the new. They are acquired in last 10 years or so. Look has low net block because of the old company and having the return of assets, quite many of them. Whereas Schaeffler India Limited is also quite old company and having the net block at the low level because of the assets age is quite old. So sum total INA and Look net block is similar to what Schaeffler India Limited is having.
Okay, thank you, sir. The second question I wanted to ask you was, it was more with understanding of the role of...
Excuse me, this is the operator. Ms. Kanetkar, may we request you to come closer to the microphone, please? You're sounding a bit low. Thank you.
Yeah, can you hear me now?
Yeah, very clearly.
Yeah. So the second thing I wanted to understand was a little bit more flavor on the role of bearings in automotive and future. There has been a lot of noise with respect to, the role of bearings being cut because, especially in the EV era wherein you won't have an engine. But I believe there will still be a lot of need for bearings and other components which would get added. So I just wanted to get a sense on, where would bearings would continue to be still a very relevant part. And although the volume might reduce, but the value content might just go up because of the sophistication that would be needed in the bearings as well. And within this, I just wanted to get a sense as our parent, where are we on that front?
Sure. Yeah, noise is what our bearings cut out, Achla. So that's the first thing. Well, jokes apart, the evolving situation in terms of the technological developments, particularly this thought that when the electric vehicles will be around, we won't need bearings in a vehicle is clearly not quite true. Granted, maybe some of the applications of the bearings that we have today may not either be necessary. For example, if there's no engine, internal combustion engine in an electric vehicle, then obviously any bearing which goes into internal combustion engine today would not be necessary in future. But clearly that ICE engine would be replaced by an electric motor, which will need some bearings. Okay. Similarly, there is some notion that the electric vehicle may not have any transmission, and hence any bearings which go into transmissions are also going to be redundant, which once again is not entirely true. The electric vehicle, to realize full potential of electric motor, may still have a transmission in them. It may not be an 8-speed or 6-speed transmission. It could be a simpler 2-speed transmission, but they would still have a transmission and there would still be some bearings in them. So that's one point of view. The second point of view that, all the noise, like you said, about the electric vehicles and how quickly they could come, is kind of now settling down into a more realistic manner. So in our opinion, until 2030, at best, India may see, 15 or maybe 20% electric vehicle penetration. That in that year, in 2030, of all the vehicles produced, maybe 15 to 20% could be electric vehicles, which only means that in absolute terms, the number of internal combustion engine production and vehicles will continue to rise from today until 2030. That's the second point. The third point, the bearings that we know today, may not remain the bearings of future. Bearings are can also be data generators with a sensor integrated in them. They can provide a lot of useful data, which can be used for data analytics, which can be used for many other purposes, whether you call it autonomous vehicle, whether you call it electrification, and so on. So I think those are also trends which will help bring more content into bearings.
Thank you. Thank you very much, sir. That's it.
You're welcome.
Thank you. The next question is from the line of Kunal Bhatia from Dalal & Broacha. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, and my question is in regards to your CAPEX. So you've mentioned 40 million euro of CAPEX. So just wanted to know how much is it for the FAG bearing standalone entity and how much for the others? And plus, out of this 40 million euros, how much have you already spent? Meaning, is it for the last year or even going forward, what would be the CAPEX?
Sure, Kunal. So, roughly out of the 40 million, we have a very, even split that the Schaeffler India, would be doing about half of that, while the other two entities, will be investing the other half. And let me just explain that, good part of this 40 million this year particularly is also going towards the construction of the two plant buildings I referenced. And one of the plant building is at INA location in Talegaon, the other belonging to the legal entity Schaeffler India Limited at Savli. So, good part of the, 40 million is going towards these two, and roughly the split between the legal entity Schaeffler India is half of the 40 million, and the other half is shared between Look and INA.
Okay. And, sir, especially in these Talegaon and Savli, what kind of bearings what kind of bearing capacity are we increasing?
So Savli is, as you know, we produce the deep groove ball bearing Gen C, low noise, high, efficiency bearings, which go into two-wheelers, which go into, consumer durable goods and so on and on, electric motors. And then it also produces large size bearings for, large industrial applications like steel mills, cement plants, wind power mill, wind energy mills, and so on. So we are expanding the capacity of the large size bearings to make, these bearings locally. We are making investments to make the rollers for these bearings locally. So the expansion at Savli as well as Maneja would be to expand, our cylindrical roller bearing capacities. We are expanding our, Tarol capacity for the railways. We are expanding our capacity for windmills or the wind energy. So those are some of the investments going into Savli and Maneja. As far as Talegaon is concerned, Talegaon, produces not just bearings, which is, a small portion of its business, which is needle roller bearing, but it produces a lot of engine and transmission components. So a lot of this expansion in Talegaon will be to expand our capacities to produce components which go into engines for automotive applications.
Okay. Thank you so much, sir. And sir, just in case of your pro forma numbers, you have given the margins, but you haven't shared the growth. So if I could get the growth in terms of the combined entity, how much was it in case of EBITDA, PBT, and PAT for the first 3 months?
So as far as the pro forma and the growth is concerned, as you know, we announced the merger mid of the last year, where other two entities being not listed, being private companies, the quarterly results were not available.
Right.
So they normally have the results for the full year, which are audited as well. but the interim period results were not available. What we could do when we announced the merger was that for the first time we could prepare 6 monthly results, which were audited as well and announced. Therefore, it was possible for us to announce the growth for the half year. So for the first quarter of 2017, results are not readily available, and therefore we are not able to show the growth. But we confirm that next quarter onwards, when we have the 6 monthly results, because we have announced 6 months of 17 results, we will be able to also provide you the growth figures.
Okay, fine, sir. And so just last clarification. So for this year and next year, the overall capex, 20 million each for the FAG and the other two entities would continue, or it would be higher for, say, CY19?
Well, we had announced that, we would be, investing, at higher levels this year, next year, and hopefully in the years to come. So, 40 million is something, we have been able to crank up in our pipeline. I think it's not just a question of, increasing the capital outlay, but also our capacity to execute the projects which take this capital investment. So, we are looking at that and seeing as to how we can, increase our throughput rate and realize those capacity increases into, realizable sales. So that's something we continue to look at that, but for sure, I think next year our current outlay is certainly to remain at the level that we are already forecasting for this year.
Okay, so 40 million each for the 2 years.
That's right.
Okay, sir, perfect. Thank you so much, sir.
Thank you. The next question is from the line of Nikunj Gala from ASK Investments. Please go ahead.
Good morning, everyone. So just wanted to confirm in your sales mix where you mentioned your industrial contribution is 81%. Can you just help us with the contribution from two-wheeler in that?
Sure. If you recollect, Nikunj, I think, we had shared, some, pretty detailed information, when we launched the merger scheme, and we had given, breakup of, the businesses as to, sector level information and so on. But coming back to the information, I think the two-wheeler would be about, let me see, 12. How much percentage would that be?
Yeah, just a moment.
We can go back to that slide, I think.
Yeah. Two-wheeler should be I just give it to you in a moment.
It should be close to 12% plus should be two-wheelers, but Mekon probably will come back to that number.
Okay. And also in your pro forma overall company level, the segment which you have mentioned, industrial and auto 57 and 43, the two-wheeler would be again classified under industrial, correct?
Yeah, so I think, Satish just confirmed that our, sales mix should be about 14% of Schaeffler India, sales coming from two-wheelers. And your question, whether, on a combined entity basis, all the two-wheeler sales will be, construed as industrial. Answer is a little complex once again. All the bearing business of, we consider that as industrial, but we have some engine components that are supplied from INA. Those actually we book them as automotive. So it's a kind of not exactly very clean, but that's how, globally we run our business. And we consider all the, typical bearing business into industrial for two-wheelers. But, if we are supplying some, engine components out of INA, they are considered as automotive.
Okay. Sorry, sir, for dwelling more. Is it possible to share the, revenue from auto customers?
Can you elaborate your question? What would you like?
Sir, usually we consider two-wheeler, CV, tractor, PC, tractor into this entire gamut into automotive customers. So can you just help us with this breakdown? How much would be going to this two-wheeler, CV, passenger car, tractor, and how much would be pure industrial?
So you would like to know from Schaeffler India Limited's revenue?
Yes.
How much is tractors, commercial vehicles, and two-wheelers?
Yes.
Okay.
And passenger car.
Would we have that number? I would not. I mean, that's not the way we analyze, so my apologies. I mean, I may not be able to give you that number right now, at least.
Okay.
I mean, roughly, I can give you some guideline. I mean, if you really have to, if that's absolutely an important number for you, I would say, since 12% or 14% of Schaeffler India Limited's business is two-wheeler, at a consolidated level, that will become half that contribution. So if you were to add to the 57% automotive, another 6%, that would make, automotive plus two-wheeler Schaeffler India Limited. And that would be, in my opinion, should be not too far off from what you're trying to get to. But once again, that's a very high-level sort of back-of-the-envelope calculation for me.
Okay. Thanks a lot, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Chaudhary for closing comments.
Thank you, Stanford. Ladies and gentlemen, thank you for participating in today's call. Due to paucity of time, we are having to have a hard close at 11. Should you have any further questions, you may please reach out to me at vijay.chaudhary@schaeffler.com. That is vijay.chaudhary@schaeffler.com. Thank you so much for participating, and we look forward to interacting with you again.
Thank you very much, sir. Ladies and gentlemen, on behalf of Schaeffler India, that concludes this conference.